Hello learners, welcome to today's lesson. We are continuing with the value added tax, and today we shall continue looking at illustrations on VAT account. In the previous lesson, we introduced VAT account and we discussed and we saw that VAT account is used to determine the amount of VAT that is going to be paid over to the commissioner or be refunded to the business by the commissioner for a given period. And the period for tax for VAT purposes is 1 month. So we shall continue with that. We're going to look at an illustration, a past paper question that was examined by CASNEB in May 2017. Question number 2, part C. So we'll read together, then we will discuss, and then we will attempt the question on the board. The question reads, John Mpumalanga is a trader registered for VAT. He also offers consultancy services for clients at a fee. He has provided you with the following information relating to his business for the month of March 2017. So consultancy for local clients, 1587, 500 shillings. For clients in the Democratic Republic of Congo, 389, 375,000. Sale of goods, exports, 400,000. Local market, 3.2 million. Email and web hosting expenses, he paid 92,000. Legal fee incurred, he paid 608,000. Import of goods for resale, CIF, cost, insurance and freight, 450,000. Consultancy fee for clients with goods on transit, 500,000. Photocopying costs, 90,000. Audit fee paid, 260,000. Purchases of zero-rated goods, 250,000. Purchase of standard-rated goods, 1.9 million. And exempt sales of 620,000. Additional information 1. On the goods imported for resale, John incurred transport cost of 50,000 and repackaging cost of 20,000 before adding a markup of 20% and later selling them as part of exports. The exempt sales, number 2, had been purchased at standard rate and constituted 25% of the batch. Number 3, on 13th of March, a customer owing 45,000 was declared bankrupt. Number 4, John received credit notes of 25,000 and sent out debit notes of 50,000 during the month. Number 5, the rate of customs duty was 25%. All the above transactions are quoted exclusive of VAT at the rate of 16% where applicable. Required. Compute the value added tax payable by or refundable to John for the month of March 2017. That is our question for today. We're going to reread the question and discuss. As we discuss this question, we're going to revisit past lessons that we have learned, and then we recall what we have learned so that we may be able to apply to the question at hand. So again, we go through it so that we discuss it. So John is a trader registered for VAT. He also offers consultancy services for clients at a fee. Now, that means that John is doing 2 things. He's consulting for a fee and he's also selling goods. So he's making 2 types of taxable supplies. Then, he has provided you the following information relating to his business for the month of March 2017. Consultancy fee. For local clients, he's going to charge. Remember, this is exclusive of VAT. So, the prices that is quoted here, for example, for local clients, 1.587, 500,000 is the value for VAT. So, we shall apply 16% on that. So, local clients, we charge VAT. And because he is offering the service to his customers, that is output. We said output VAT is VAT that you collect from your customers when you sell taxable goods or when you offer taxable services. So in this case, he's providing a taxable service. So we charge, he shall collect VAT on that. Clients in the Democratic Republic of Congo, in our earlier lessons, we said in the VAT Act, the commissioner has provided a list of the zero-rated supplies and the exempt supplies. And we said that we can refer either to the Act or we refer to our study text, where we will find all those in the first and the second schedule to the VAT. Now, if you go back to the schedule, either to the Act or to our study text, you will find that exports are zero-rated. We had said in the previous lessons that if a supply or if a transaction is zero-rated, it means that, yes, once you make that supply, you will charge VAT, but the rate you're applying is 0%. So 0 times any figure is 0. So where we have clients in the Democratic Republic of Congo, we shall charge VAT at 0%, and that will amount to 0. Sale of goods, exports, again 0% because exports are zero-rated, and local market 3.2 million. So John will collect output VAT from his customers. Then email and web hosting expenses. That is a taxable service that John is receiving from his suppliers. So he shall claim input VAT. Then legal fees incurred, again, he's receiving that from his advocates, so he's going to be charged, that is input VAT. Import of goods for resale, cost insurance and freight at 450,000. Now, in our earlier lessons, we had said when you have goods and they are imported, we said that for imported goods, we'll do our workings here. So for imported goods, value for VAT is equal to value for duty plus duty. So we go through this sentence again, and then we find out what is the value for duty, what is duty, therefore what is the value for VAT. So import duty, cost insurance and freight. So we have CIF price for these goods was 450,000. So what we need is duty. Add duty. We are told in note 5 the rate of customs duty was 25%. So 25% times 450,000. That is a quarter of 450. So we compute that. 450,000 times 0.25. 112,500. So 112,500. So this gives us value for VAT. So we add 450 plus 112,500 plus 450,000, 562,500. Now this is our value for VAT. So therefore, input VAT will be 16% of 562,500, which will give us times 16%, that gives us 90,000. So on the goods that we have imported, we take value for VAT, that is the CIF price, the cost, the insurance and the freight up to the port for 50, add customs duty, 112. If you had excess duty, you would also add it, value for VAT, and then we compute 16%. Then consultancy fee, clients with goods on transit. Again, from that schedule of zero-rated supplies, when you offer taxable supplies to someone who's transporting goods, then or whose goods are on transit from Kenya to another country, that is zero-rated. So that being zero-rated, we shall collect, or John shall collect VAT at 0%, 0. Then photocopying costs, that is a cost that is an input, so he claims input VAT. Audit fee paid, he claims input VAT. Purchases that are zero rated, he is going to pay VAT at 0%, and standard rated, he pays VAT, input VAT at 16%. Exempt sales, 620,000. Now, on the imported goods, note 1, on the imported goods for resale, John incurred transport cost of 50,000 and repackaging cost of 20,000 before adding a markup of 20% and later selling them as part of export. So we want to continue with this so that you can see how much he's going to have. So value for VAT is 562,500. You remember that VAT is not a cascading tax, meaning that VAT is not taxed. You can't charge VAT on VAT. So that means, although John has paid this input VAT of 90,000 at the point of import, we cannot add 562,500 plus 90 to arrive at the new value. So we take this, we exclude 90,000 because we are not supposed to charge VAT on VAT. So we continue with note 1. On the goods imported for resale, he incurred transport. Now, much earlier, we said you're going to add value and therefore charge VAT anytime you transport goods, or you manufacture goods, you change the form, or you warehouse goods, or you sell. So whether you're selling, you're storing, you're transporting, or you're manufacturing, you will be adding value, and we're going to take a proportion of the value that you've added, 16%, and that will be the VAT. So in this case, when John imports the goods and he incurs transport cost, he has created utility, or he has created value. So we add transport. So we add here the value that John is adding through transport. We call that place utility when you're bridging the geographical gap between one place, the place of consumption, and the place of manufacturing. So this is 50,000. Then he repackages the goods. When you repackage, you're breaking bulk. When you break the bulk, you're changing the form. So repackaging. At a cost of 20,000. So as at that point, John has incurred 562,500. 562,500 plus 50 plus 20. He has incurred a total of 632,500 shillings. 632,500 shillings. This is the total cost of production. Total cost of production. We continue with note 1. Before adding a markup of 20% and later selling them as part of exports. So he's adding a markup. Now in financial accounting, a markup is a percentage of cost, while margin is a percentage of sales. So it means the profit that John is expecting from this transaction is 20% of the cost of production. The cost of production is 632,500 shillings. So we add the markup. So we add the gross profit markup. GP markup, which is what percentage? 20% of 632,500 times 20%, giving us 126,500. So 126,500. So as at that point, the selling price exclusive of VAT is, we add the two, 126,500 plus 632,500, 759,000. So on that, output VAT